If you look at some of the guys that are operating in New York City, they built and then became lenders. That's one of the premises as to why they're doing that type of financing.
Exactly
So
right.
you got to be, I'm not saying it's not right what you're saying. It's just not a global, right? It gets into a nuanced position.
It's not a global rubric for.
But Leo, you want to tell me you're not renegotiating interest rates with banks? That would be hard for me to believe.
So the answer is yes, and the answer is no. It's yes if, like Bob said, the attitude of the lender is amicable. But sometimes you got to tenderize the meat over there.
If they're looking at the personal financial statements,
they're not. We're never going to let them look at it, because if you're at the point in litigation when you're looking at the personal financial statement, allow me to finish.
Pre-litigation.
Yeah. Well, even pre-litigation, we're not sharing that information, because everything you're going to be giving a lender to prove that you as a personal guarantor can pay something back puts you in a more difficult position. Why? Because the lender says, oh, great, he actually does have the assets. We're definitely defaulting him. We're definitely going to receivership, and we're definitely not going to go to mediation because he has all the assets to pay back. And then you're scurrying, trying to hide him, which is illegal. It's a fraudulent conveyance. Please don't do that. Please don't go and collect $100 and do that. Go to your lawyer. Please call, your attorney.
Jacobs
PC. But yeah, you are negotiating. And then there's the no. Then there's the yes then there's the no where they're like, we didn't do anything wrong. We're actually not your partner. And we're going to sue the fuck out of you to make sure that we get not only that piece of land, but we will also go after you personally. And then they'll tell you it's nothing personal.
What if they don't have a PG signed?
No, we can get into the nuance of it. Let's talk about something that I think is relevant to the four of us. And I'd love to hear Bob, because of his wealth of knowledge, on the following subject. We're seeing, right, because it's about the return based on risk-adjusted returns, okay? And that's how we create this new market of buyers or people doing deals, right? Because we keep talking about transactions down and all the shit that's happening. What about moving forward? So think about cost of capital, right? You have senior lenders, right? They're looking for these spreads, and you're seeing these funds, and they're getting teen returns on first position debt for construction, financing, and land. Then you've got mezz and pref, right? 18 to 22 is what they're searching for. And as Bob will tell you, a lot of them, what is common equity's expectation in order to underwrite, to refinance, or to do any deal in New York City? So
in
Bob,
this market? No,
in this
nothing.
market. So Bob, and everyone's coming to me for pref, mezz, senior, and common equity. And I'm shocked. What do you think it's going to take, Bob, to get transactions going again? And then from the people that you see, because you're seeing the players that are structuring the deal,
yes,
what is their return expectation now
tell us
on new
about
stuff? Let's tell me the new world now. Let's forget about how screwed everyone is. How's the new world looking at wanting to buy a deal?
Well, if you're talking about a construction project,
let's talk about that. Let's talk about construction.
Development models. Everybody's looking for at least a 2x equity multiple. Deals were underwriting a lot tighter. They were down 1.5, 1.6, and it was tough to see things pencil to more than a 5 cap or a 6 cap on new construction. And then cap rates on existing started to get to the same level. People said, why would I take the development risk if I could get
buy something ready to
existing
go?
cash?
Exactly.
Level?
That's what all my developers are saying.
So it's changed, but I think what we need to see is we need to see some stability in the debt markets.
What do you mean by that? What do you mean by stability?
I mean rates coming down. I think people are starting to feel, if you took a consensus of market participants, very, very few people think rates are going to go up from here. They don't know. We don't know when they're going to fall or how much they're going to fall, but people are pretty confident, hey, they're not going to go up. That's a very positive thing for the market.
Okay.
But once you start to see maybe a couple of reductions in rates, that's a positive sign, because the base rates impact lending rates. And then we'll maybe start to see more competition to put money out. And then also you're going to give comfort to the equity players. There's still a lot of equity out there. There's a ton of equity.
On pause.
It's just really expensive. Because
expensive.
If you don't want to put money out, and you're an equity fund, you don't say, hey, I'm not putting money out now. You say, yeah, sure, I'll put money out. Yeah, I want 22%. So effectively, you're saying I'm not in the market, but you're not saying you're not in the market.
Can I blow up?
Yep. So you need comfort and certainty, which will compress spreads, we'll get more equity in the game. The more equity that's in the game, the more competition there is, the lower yield expectation that equity has, the more lenders that get in the game, they compress spreads as they get more competitive to put money out. And then you get into what economists refer to as a positive feedback loop, which is a positive, but we're not near that now.
But just to say to our audience, compressing spreads means you can pay more, right? You can, when you are acquiring that asset and developing it, it's more accretive cost to the asset instead of giving a lender money, right? It's less interest to them, more that you can actually just spend on the actual asset, right?
Well, and it's more yield that you will make is paying the same.
Right, you
thing
pay
for
the same, but
property.
you just make more money.
Well,
So my question though is, you're seeing that. So what's happening right now? Are the bid asks off?
We have not reached capitulation, right? I thought we had reached during every rebound. You have to get through what we refer to as the capitulation phase, where people who want to sell finally say, "All right, you know what?
Lens of reality.
selling."
I
Are we
call
there
it.
yet?
I
Are
like
we there yet?
capitulation.
No,
No, we
Almost.
thought we were in the third quarter. I
Almost.
think if you look, we always use as a barometer the Manhattan investment sales market, because whatever's going to happen in the city will happen in Manhattan first. We look at the market for deals over $10 million south of 96th Street. First quarter of last year, there were 42. Second quarter, 43. Third quarter, 84. I said, 84, it doubled.
Yeah, we're going.
Maybe we're reaching capitulation, but I always caveat my take on the market by saying trends only happen after 2 or 3 quarters. You can't
Correct.
base it on one.
Consecutive.
correct. Consecutive.
Consecutive quarters.
Consecutive quarters.
And the fourth quarter stunk. I mean, it was 33 sales. So it was
We're on
below
we're
the
onto
lowest.
something.
But Bob,
Right?
in the trenches, what do you, like?
Shit.
What are they saying to you? Did they show you their underwriting, meaning the buyers? They're like, this
Sometimes.
doesn't make any
Well, no,
goddamn.
but
This
I
doesn't
think
make any sense.
It's at this point, it's much more important the sentiment. And I think one of the conversation I had, look at the uber wealthy class, right? The folks with 9 figures of liquid net worth sitting in the bank that are real estate guys and gals. And you brought them deals over the past 2 years. The conversation was identical every time. Bob, it sounds like a really great deal, but it's going to be cheaper in 3 months, so I'm going to wait.
Yeah, right.
They're not saying that anymore.
What are they saying?
They want to get back into the game because the Fed has said, hey, we're not going to raise, we might lower. And before the inflation numbers came out 2 weeks ago, the expectation was to be February or March, there'd be a cut. Now the inflation numbers were not good. Who knows when they're going to cut? But that capital has said, all right, I want to get into the market, and maybe we're near the bottom. And you can never get time exactly the market at the bottom, because you won't know you're at the bottom until 6 or 9 months after you're beyond the bottom. And I told these rich folks, I said, look, in the GFC, value bottomed out in the second half of 2010. Do you think everybody that bought in 2009 isn't thrilled that they bought that deal in 2009?
Yeah, but if you're too early, which is also what I hear, which is fascinating, the guys that were buying up, sort of inventory condo on the cheap, then when they went to the market, it hadn't popped yet, and their returns weren't there for what their expectation was.
just missed it.
If you waited another year, they killed it, right? So it's fascinating to hear that you don't perceive that capitulation is there.
No,
I keep hearing about the cost of capital. I'm like, I can't underwrite an asset that makes sense for you to put money in. What we're seeing is just in markets outside of
But
New
Eric,
York.
what's happened is simultaneously, because it's had a 2-pronged effect, the Fed's statements. The capital now wants to get in. But the flip side of the coin is that the sellers who don't have to sell, there's two big batches, three batches of sellers. There are the folks who have to transact.
Right.
Death, divorce, taxes, partnership, dispute, whatever. We love those folks. Then there are the folks who...
Those are my folks.
Leo loves
Yeah.
those folks.
Then there are the folks who have a very compelling strategic reason to sell. Portfolio realignment. I'm selling B and C properties. I'm going to buy A property.
Yeah. Right.
I'm selling in New York City. I'm going to go buy in Florida, Texas.
Right.
I'm selling all my multi. I'm going to buy industrial, whatever the case might be. And then you have the basket of truly discretionary sellers who only sell because they can get a good price. Each of those 3 buckets, they have a very different mindset, perform very differently. But what has happened is the folks who are not in bucket 1 are saying, oh, the Fed's going to cut rates. This really disappointing price that I've been offered, I'm not going to take that. I'm going to wait. If rates are coming down, my price is going to go up.
Yes.
So it's created a little bit of inertia, and the gap still exists only because even though all the capital wants to get in, the sellers are a little more
They're
hesitant
lagging.
now.
They're lagging.
You know what we're also seeing, which is I'm curious if you hear the same, is the 9-figure guys. They were like, you know what? I'm going to get into credit. Why am I getting to the asset? I can get into credit, be first position, and do like a crazy amount of deals.
That's
so
right.
it's like the same guys that were common equity were now doing credit deals, and they're like, wow, this is a great return.
100%,
And now
because they're either making high teens returns or mid teens return on their money, and if they end up owning the asset they bought,
They got at the number they said that they wanted.
90%
Yeah, it's
of
crazy.
what they should have paid.